Good morning. It's Wednesday, the 22nd of January, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming as always from Mumbai, India's financial capital, regardless of which government is in power in the United States of America, and more on that shortly. The take. Were you the same person 4 years ago? This was the response to a question on what could potentially change for the financial markets with the new Donald Trump presidency that took charge on Monday in freezing Washington, D.C. Now, my poser was to a Dalal Street money manager who, of course, is programmed to generally look at the positive side of things. Combine that with some experience and a few market cycles, and you have a good chance of landing close, if not on target. Now, that did not quite happen on Tuesday in trade. But nevertheless, where are we a day after the inauguration? Trump has already unleashed a series of executive orders that are predominantly focused on internal and cultural issues, while the key economic ones or threats are still in abeyance, which is of course not helping anyone, and we'll come to that. A useful and quick analysis from Axis Capital here says that nearly 4/5 of President Trump's first 45 executive orders focus on appointments, cultural issues like freedom of speech, and DEI, which is diversity, equity, and inclusion, and changes in processes, including rescinding about 78 executive actions taken in the previous administrations, that's between 21 and 25. So what about the ones with economic impact? Well, they include immigration, energy, and pulling out of multilateral forums or fora like the Global Tax Deal, WHO, the World Health Organization, and the Paris Agreement on climate change. In many ways, these were somewhat expected, but may not have been top of mind like the tariff threats of the last few months. The key economic threat that has kept global economies guessing is obviously the sweeping tariffs on all countries, including India, on which there is already a tactical retreat saying that the United States will study things and then move. Now, there is a renewed threat of a 25% tariff on Canada and Mexico to nudge them to stop the flow of undocumented migrants, of which, by the way, India is a healthy contributor at this point. So, Trump has promised sweeping tariffs, annexation of foreign lands, and deals with whoever is willing to strike them. But who could have guessed that the first deal would be to breathe life into a social media platform from China suspected of stealing data from American users and then banned on grounds of being a national security risk? Incidentally, last month it was revealed by the Wall Street Journal that the US government was taking aim at TP-Link, a Chinese technology company that dominates the home and small business router market in the US amidst mounting national security concerns. TP-Link has a fairly good market share in India as well, if I'm not mistaken, in the double digits. But in the US, TP-Link apparently holds a 65% market share, and federal authorities were investigating TP-Link following reports of its routers being exploited in cyber attacks allegedly linked to Chinese state actors, according to those media reports. A recent Microsoft report said compromised TP-Link devices were used in ransomware operations, fueling concerns about the company's role in facilitating cyber threats. So bottom line, the hardware and software that is dominating America in more ways than one is controlled by China. And it looks like it'll stay that way for some time. And this, by the way, is the opposite of what you may have heard on campaign trails. So which promise will the Trump administration uphold or hold? Well, like I said earlier, there are already evident tactical retreats. Since TikTok has got a reprieve, even if a temporary one, to allow the Chinese company to find a 50% American owner, then it's quite likely other areas like tariffs are also in some kind of hold, at least in the case of China. Now, if that is the case of China or with China, then what sense does it make to slap tariffs on India? So then almost everything, except for perhaps illegal immigration and some of those cultural issues on which some dramatic measures have been announced, are open to negotiation. And on immigration, with Trump confidant Elon Musk batting for H-1B visas, quite likely the regime could be relaxed, and I'm talking about the legal regime, instead of being jettisoned. Illegal immigrants will be hounded for sure, but businesses need them too. The only problem being that these businesses are more traditional service and manufacturing industries rather than rocket launching enterprises. So maybe they won't have a voice. And finally, what about the stock markets who've been on the tenterhooks gearing up for a major global trade war, which does not look like it'll happen, at least not in the way it was threatened a month ago? Well, it's all priced in, says this money manager. Which is true, but what's been priced in is a definitive move or a series of definitive moves and not uncertainty. Markets like definitive moves in any direction and not uncertainty, which is what President Donald Trump has now reintroduced by staying silent on these tariffs. As a businessman, President Donald Trump should know that uncertainty is bad. And perhaps therein lies the answer to the question that I posed in the beginning. Has he changed in the last 4 years? And that brings us to the top stories and themes for the day. The stock markets crash again, this time on Trump policy uncertainty. Oil prices ease off on increased supply triggers. The Trump presidency and the Asia view. Revenue growth slows in India as construction industry drags. And what are some of the indirect tax expectations?
This is the Core Report with Govindraj Ethiraj.
The markets take a steep dive. The stock markets fell sharply as uncertainty over Donald Trump's tariff plans on India rattled traders. While Trump's present tariff threats from February 1st are more to do with immigration flows from Mexico and Canada and thus are targeted at them, the possibility of blanket trade tariffs across the world is still lurking. And the benchmarks took a beating yesterday with the 30-share Sensex falling 1,235 points to close at 75,838 after some wild swings, including having opened positively in the morning. But remember that foreign institutional investors are continuing to sell and likely are bringing down the markets every time they creep up. The NSE Nifty 50 was down 320 points and closed at 23,024. The broader markets took a hit too, with the Nifty Midcap 100 and the Nifty Small Cap 100 both closing down about 2.3%. The good news, if you choose so, was that gold prices have now risen to a 2-month high as the US dollar weakened and investors bought into gold, a totally expected phenomenon at a time like this because gold is definitely a more certain investment in an uncertain time. Spot gold was up slightly to $2,722 per ounce, reaching its highest level since November 6th and coming close to the all-time high of $2,790 per ounce set in October, according to Reuters. Meanwhile, the dollar index slipped slightly, holding close to a 2-week low hit in the previous session, making bullion obviously more attractive for other currency holders. Meanwhile, Trump on Monday revoked a 2021 executive order signed by his predecessor, Joe Biden, that tried to or sought to ensure that half of all new vehicles sold in 2030 were electric, according to Reuters. The rupee gains and then loses. The rupee lost most of its early gains on Tuesday to close largely unchanged after the US dollar recovered when President Trump said he was thinking about imposing tariffs on Canada and Mexico. The rupee closed at 86 rupees 57 paise against the dollar, down from its close of 86 rupees 56 paise in the previous session. The dollar index was up slightly after it touched a 2-week low on Tuesday. Oil prices ease off. And here is our India Energy Week segment. Even as the threat of tariffs continues to hang over countries like India, it does appear that oil prices are facing downward pressures because of a potential increase in supply. And of course, there are other changes in the equation. India could increase its purchases of US oil and gas after President Donald Trump's announcement to maximize US oil and gas production. India's oil minister, Hardeep Singh Puri, told reporters on the sideline of an event that there is a possibility of more energy purchase between India and the United States, according to Reuters, which reported this. And he said that more US energy coming into the market is welcome. Trump on Monday said he would immediately declare a national energy emergency, promising to fill up strategic reserves and export American energy all over the world. Now, India imports over 80% of its crude oil requirements and has been affected by a spike in global oil prices and shipping rates after the US, under President Joe Biden, that's literally 2 weeks ago, imposed sweeping new sanctions targeting Russian tankers, oil producers, and insurers. India's oil minister reiterated that there was no shortage of oil in the market. Earlier, Russian oil accounted for more than a third of India's imports last year, but US sanctions are tightening supply, and this has led India back to traditional sources of crude oil like the Middle East and now the United States. Meanwhile, Reuters is also reporting that Indian refiners have issued tenders this week seeking crude oil after those disruptions in Russian supply. And those tenders come more than a week after those sanctions from the United States, which disrupted supply from the world's second largest producer, that's Russia, and also tightened the availability of ships. And finally, Brent crude futures were down 65 cents to about $79.50 a barrel, or under $80. This segment was supported by India Energy Week 2025. That's scheduled from February 11th to 14th, 2025 in New Delhi. And you can register for the same using the link in the show notes. The Asia view on Trump. Analysts world over are debating and discussing what the Trump administration's likely trade policies could do to the world in coming months. There is the China view on this matter, of which we are hearing a lot, and then there is the rest of Asia, including India. Remember, not all economies are performing equally, and then there is also the currency matter, which in some ways unites Asian economies because all of them have been under pressure thanks to that ascendant dollar. I reached out to Priyanka Kishore, founder and principal economist of Singapore-based macro consultancy Asia Decoded. And I began by asking her how she was interpreting the first raft of policy moves from the Trump administration, but through an Asia lens.
Of course, markets are busy celebrating right now. We did not get any tariffs in the inauguration. But I would add a cautious tone. We have been saying for a while now that universal tariffs will hurt the US and they're likely to take a more targeted approach. And from where I sit, I see it as the administration buying some time, but not saying we will not do tariffs. So as far as, Asia is concerned, which is a more open region of the world in terms of trade, many economies are more trade oriented. I don't really think those risks have disappeared yet. We can have our CNY celebrations, but post that we will come back to these growth and tariff risks.
The other point is really the dollar, which has been going up and down, but it's been strong and now seems to have slightly eased off. And obviously, all Asian currencies have been under pressure, including the rupee, which is going through its own strategic response on whether to let it float a little bit or not. So how are you seeing the currency response, particularly across Asia?
I think I'm with you on that the dollar has given up some of its weakness overnight. It's very linked to the US policy outcomes, right? All the policies that the Trump administration are proposing, they are of broad dollar strength. Even if they say that they want a weaker currency, that's not how it works. And to that extent, I think this is a year of Asian currency weakness. In the region, we have usually had managed weaknesses. So I'm still not looking for, sharply falling knives out there. But India, I think, is an interesting one to watch out for because we've kept the currency in a de facto peg for so long. Then we have let it go now. But I still think, I'm looking for FX weaknesses between 3 to 5%, which is not that concerning in an environment of dollar strength.
What other signals are you taking away, Priyanka? Like, for example, a lot of exports into the US from Vietnam or Cambodia are originally Chinese companies. The US government has talked about, separating that, source Chinese investment versus local investment and so on. So are you seeing those as issues going onward? And I think the larger question is, what's the framework of mind that businesses or analysts like yourselves are approaching the next few months?
I think there is a huge debate, and especially on Vietnam, as to, whether it's a beneficiary or whether it's going to bear the brunt of this administration. To my mind, I see three things. One is, of course, the direct bilateral trade balance with the US. The second is the bilateral trade balance with China, which this government is going to scrutinize pretty closely. So the origin of imports coming in, how much of those imports are actually intermediate inputs into your manufacturing versus you just rerouting finished goods from China, which is what you're referring to. And also the currency angle, right? The currency manipulator watch list. So, there are 2-3 ways they're going to come after the other countries in terms of determining tariffs. And when I put these in perspective, of course, China is there. But after China, to me, Vietnam, Japan, and South Korea, these seem to be the most vulnerable to tariff risks.
And are you seeing any trends early or projected on the geopolitical front? I mean, do you see any shifts in alliances or new blocs in this region again?
Actually, from where I am sitting and the people I'm speaking to, there seems to be a sense of relief on the geopolitics. It does seem that, the Trump administration is considered more transactional, a word you would have heard ample number of times by now. And to that extent, maybe less interfering into, how countries conduct their geopolitical relations, the softer relations. So it does seem like, they would be less interfering when it comes to Taiwan. Also, speculations on when Taiwan going to be a negotiation tool are largely underplayed, at least here in Singapore. So geopolitically, it does seem that because this government is less focused on human rights and those kind of issues, it might actually be a better year for Asia.
And how are you seeing overall growth prospects? And within the region, are most countries in the same secular growth matrix right now? Are there big differences?
One thing you can definitely look at is who is more exposed to global slowdown, who is more exposed to a Chinese slowdown, and who is more driven by domestic growth drivers. So, India sits at a sweet spot there, despite, some consumption challenges domestically, but it's a domestic problem. It is less exposed to, what is happening in terms of tariffs or what is happening in terms of a China slowdown. Not a complete, shield there, as you could have some knock-on employment impact on the exporting industries. But if I were to rank, so it's at that end of the spectrum. On the other hand, the country where I'm sitting, Singapore, very open, very exposed to China. So it is probably one of the most downside risks. I already spoken about Vietnam. And the ASEAN economy is probably somewhere in the middle. So I would say that Singapore, Vietnam, Northeast Asia in general, more exposed to downside risk. Southeast Asia in the middle, then India probably has more concerns domestically, but external-wise is better placed.
Right. And last question, if I were to just come back to currency, so are you seeing a stable dollar through the year? Or at least the foreseeable far part of the year?
I think any dollar weakness will be short-lived. So in an earlier life, I was an FX strategist. And if I were to borrow from those years, I would say it's a buy on dip story for the dollar this year. Asian central banks have growth risks to contend with. So in general, I think the rate cycle is turning here, right? So it's not even like you have active rate hikes coming in to support the currency against strengthening dollar. A year of dollar strength, and that has implications for how the rate cycle will proceed, how FX results will be managed, and what will happen to currencies.
Priyanka, thank you so much for joining me.
Thank you for having me.
Revenue growth slows for India Inc. Revenue growth for India Inc. likely fell or declined about 80 to 90 basis points year on year to 6% in the 3 months ended December 2024, according to CRISIL Intelligence in a new report. That's levels of 4 to 6%. Now, this is based on an analysis of 400 plus companies that account for about half the listed market capitalization, says CRISIL. The report says this is because the construction segment, which accounts for a fifth of overall revenues, dragged because of an extended monsoon and slower recovery in government spending after the general elections, while the industrial commodities and investment-linked segments had a subdued outing, which I would think translates into, again, not a very strong performance. However, on a sequential basis, revenue grew about 5.2% compared with 2.4% in the July to September quarter. Profitability is seen going up about 40 to 50 basis points, driven by export-linked sectors, with earnings before interest, tax depreciation and amortization possibly rising about 8%, says CRISIL. It also says that amongst the top 10 sectors that account for 70% of overall revenue, 4 likely saw EBITDA margin expansion, led again by export-linked services or other sectors such as IT services and pharmaceuticals, and then investment-linked sectors such as power and construction. Steel, automobiles, telecom, fast-moving consumer goods, cement, and auto component sectors may have seen margin contraction. The automobile sector's revenue likely grew 7%, says CRISIL, thanks to a rise in the volume of cars sold, which in turn was led by healthy festive demands and higher realizations due to a change in the product mix and increasing share of exports. Elsewhere, it's all growing, but as we said earlier, slowing than anticipated. Retail sector continued to grow thanks to those festive sales that we referred to, according to CRISIL as well, which also added that in fast-moving consumer goods, the staple segment is expected to grow about 6 to 8%, driven by price hikes, though the demand is muted. While demand recovery in the hinterland is expected to sustain, the urban side is expected to remain subdued next quarter as well, says CRISIL. What lies ahead for indirect tax? So the discussion may have boiled down to multiple tax rates on different types of popcorn, but there is no doubt that simplification of the goods and services tax regime or GST regime by reducing the number of tax slabs is critical. Indirect taxes contribute almost 60% of total tax receipts. And any changes here can obviously reduce the tax burden on consumers and potentially increase consumption. Now, there are a raft of expectations on the taxation front as well, including on imports and then demand for amnesty schemes for pending litigations. The union budget is being presented on February 1st. I reached out to Prashanth Agarwal, partner at PwC, and I began by asking him what were the key expectations from his camp on indirect tax.
Yeah, on the GST front, I think I'm looking at how do they further plan out on the GSTAT perspective in terms of beginning of that. Would they make more simplifications around the GST law? And they brought in certain compliance-related changes, which are invoice management system related changes which came out on the GST, whether they bring it as part of the law that one can look at. Some of the aspects around how the procedural aspects on the GST will be taken up. That is something that can look out. I don't think major changes will be made on the GST front because, as we have discussed in the past, it is the council which really takes the calls. Those get ratified through the bill if it is required to be undertaken from an amendment standpoint. So nothing which would be surprising, I feel, from a GST standpoint. But yeah, I mean, one can make a wish list of whether they will start including goods which have not been included from an amendment standpoint, natural gas, etc. But we know that it has yet not been decided in the council, so it won't happen in this meeting. So there is a laundry list of wish list, but unfortunately, because most of it has not been approved upon from a council perspective, may not happen.
So the other element of indirect tax is obviously customs. That is one area where there are lots of expectations.
Sure. So I think on the custom side, I would divide it into 2-3 parts. One, from a procedure standpoint, there are certain compliances which the industry has been pushing for simplification. So like there is a compliance which is required to be done for related party imports, which is known as special valuation branch procedure. So there the industry has sought for simplification because there are a lot of delays in terms of getting those special valuation branch proceeding orders undertaken. Second is around simplification of the authorized economic operator scheme, which is basically helping through the V-channel imports. So there also the industry has made representation and looking for some kind of simplification. Third is around sector-specific benefits like airports. There has been asked that whether benefit like project import can be extended to them. So that's something which is being discussed about. Fourth would be around the exemptions. So we know that the FM had in the past made it clear that the exemptions which are there in customs would be there for 2 years and they would be revisited. So a lot of sectors are seeking renewable of those exemptions as well. Then, of course, benefits to solar industry, EV, because these are the themes which are playing out well in terms of investments, will continue to be sought after from the industry's perspective. And lastly, because there are a lot of litigation which are coming up on the customs side, which have been dragging on, that again is a piece where the industry would want to see some kind of relief. As we have seen the trend the government had brought in the last budget, Vivas Vishwas, from the income tax perspective, then even in GST, there has been amnesty scheme. And the similar ask is there on the customs side to take care of the past litigation. Could there be something like a amnesty scheme which can be really brought out? So those are big themes which may play out as you move along. And last, if I can make, FM had made a declaration about simplifying the customs law. White has really not seen much on that. So what are the steps taken on it and where do we see moving from that perspective? Would be good to hear from an FM perspective.
Two quick questions. So one is, you mentioned exemptions. Is there an illustration of what kind of exemption that people want to be continued or removed? And the second is, are you seeing anything, or is there a clamor on anything on the tariff front itself, on the actual tariffs?
Yeah, so I think on the exemption front, there are exemptions provided to automobile industry in the EV sector. So that's something which obviously on the parts and components side, companies would want it to continue because the ecosystem is still getting developed. The other would be around the whole sector of EMS, which is already there. So there again, on the components, essential components, something would be required. Also on the solar side, wherever possible, not the exemption, but at least the lower rate of duties, if they can continue, is something that the industry continues to look forward for. Solar already, there have been a lot of increase in the rates which have happened. And of course, they would want to seek wherever there are benefits left over. Because we have now battery storage system which is coming up. You have green hydrogen which is being talked about. So on those new areas of investments, companies, semiconductor as an industry, there are investments which are being made. Are areas where at least concessional rate or the exemptions is something that they would look at. Simplifying the process of claiming the exemption is also something that is there. So there are procedural aspects which at times create a hindrance in terms of claiming those exemptions. So there again, there has been an ask from the industry to see if that can be taken care of. Some of the other sectors, I would say MRO, there already the exemptions have been there. So they would want to see if those can continue from their perspective.
Right. And nothing on absolute tariff itself, right? Yes.
Yeah, again, on the tariffs, the expectation was that some of the announcements one can expect because the tariffs have been increased over years. And as you see, since you are saying that some of your ecosystem on the manufacturing side has matured, you would want to make the industry more competitive. So from that perspective, the tariffs are something where you would want them to be more normalized than increased further. So, I mean, that's what the expectation would be, that you are making it a more free, competitive market. So why not?
Prashant, thank you so much for joining me.
Thanks as always.
That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.